Equity markets continue to track higher. We're north of 4,000 on the S&P. If I came to you and said, is now the time to start hedging? Is it cheap enough to start hedging some of these moves? What would you say to me?
Our expectation is the markets can continue to go higher from here. And, we expect the VIX, maybe not in a linear line down, but the VIX to renormalize back towards levels that are, in the mid-teens, over the next several months. It's not unreasonable that we get there. The economy is in the process of healing. We're reopening. And I think all of that supports what we see in the estimates. Earnings for S&P 500 companies continue to drift higher and remain quite robust. And valuations are not all that extended, particularly in the context of other alternative asset classes. So I think it all points to continued upside for equities at this point.
So I guess, Patrick, the question is where within the equity market? If you were going to bet on the reopening trade, we've seen that within value. But in the last few days, you've had a strong big bid into tech. And it seems like after that dovish minutes release yesterday, and what Evan said, you are looking at a resurgence of the stay-at-home trades instead.
For us, the issues that we are tracking is what's going on in interest rates. And to the extent that we continue to see the 10-year rise, and it's our expectation that will be the case as we continue to see the economy accelerate, then we believe the value trade, as you said, is going to work. I mean, that's groups like industrials, materials, financials, portions of discretionary are going to be the themes that are going to outperform as we go forward. It's not to say that, as we continue to debate some of these tax issues, that tech is a probably bigger beneficiary or loser on some of those dynamics. And I think we're continuing to kind of tease out those details. And that's probably why we're seeing incremental movements there. But I would expect that pro-cyclical value-oriented trade to be the leading theme here for the next several months as we reopen.
Patrick, where is the money coming from? I'm genuinely curious about this question because I see money market funds continuing to attract more funds, and they've certainly been going up over the last few weeks. Are people selling out of their bond market portfolios and putting that money to work in equities? Does that trend continue? If it is that trend, you talk about the fact that you think yields will continue to go higher. Is this a kind of rejigging of the 60-40 to maybe something different in terms of the allocation that we're seeing? I'm just curious as to the sustainability of this drip, drip, drip of money we're getting into equity markets right now.
So I think it's two things. I think you do have traditional investors probably taking a closer look on that traditional 60-40 model, looking at what the alternative options are relative to a fixed income portfolio and seeing that equities in many instances are giving you similar yield on dividends and you're getting growth against it. So I think that is absolutely one area. And then I think the other area is the fact that realized volatility continues to fall. We're seeing the VIX continue to come in. What that allows hedge funds to do is to incrementally take up leverage. And that's going to be the incremental demand that's coming to the market. So it's going to be both of those, but that's really where the money is coming from.
So, on the other hand, there are some, and Mike Wilson of Morgan Stanley and also Tobias Lefkovich of Citi are starting to sort of warn that we're a little too frothy. Tobias recently had a note out that said that taxes, nope, wrong one. So the S&P is broken out of our expected 36 to 4,000 trading range with a sense of this time is different, overwhelming, discomforting signals. Sentiments very worrisome territory as is valuation, yet money flows continue to push indices higher. That there's just too much bullishness in the market. Where might that be true?
Well, I guess what I keep coming back to is what is going on with the underlying fundamentals. We're seeing growth exploding to the upside here in 2021 as the economy reopens. That's particularly true within values more so than the growth component. If you're thinking about Russell benchmarks, I mean, many growth companies think technology didn't even see a recession last year. So the earnings are really exploding the upside, and that's really what's driving markets. It's not necessarily that we're seeing valuations continue to extend. Actually, valuations are incrementally coming in because the E and the P is going up so strongly. So we don't, as we continue to move forward, that upward drift in estimates is going to put downward pressure on valuations. And I think that's going to keep investors incrementally interested in equities, particularly relative to the other options that are out there.
In terms of which bits to kind of carry on the conversation you want to be in, though, like small caps have had an incredible run. That started to fade a little bit. Where am I sort of migrating to next? We've had the catch-up trade has in some ways played out really strongly in some areas of the market. Do you think that trade still has more to run? Do you think you want to be more balanced in terms of the parts of the market you're occupying at the moment? You've done well if you've shifted out of tech and back into those small caps. The value's played really well. But do you want to be a bit more nuanced in terms of the balance you want to have within your portfolio, as so much of that catch-up trade maybe has already happened?
So, if I can think about it from a different perspective, think of it as low quality. That's really been the area that has been outperforming since early November, and it's had tremendous runs. Whether you think of it as within the S&P 500 or within small caps as an index. If you ask me where the opportunity still exists, particularly as some of these areas have run, I think small caps still work from here. They have tremendous operating leverage, and they're going to benefit as the economy reopens. If you're looking within a large cap universe, though, my area of focus would really be within the financials. They're an area that has seen tremendous capitalization in light of the recent crisis, and I think the issues have turned out to be much less of a problem in terms of bankruptcies and some of the things that they were reserving for. And I think as we go forward, the valuations are among the most favorable within the large cap space. So within groups, I think financials, particularly within the large cap area, look the most opportunistic.